Hello, today's presentation is on behavioural finance. My name is Simon Molliker and I'm a fund manager here at AJ Bell. I work within the investment team and I specifically focus on the active managed products that we deliver here at AJ Bell. So today we'd like to talk about behavioural finance, and the agenda is talking through what behavioural finance is, looking at the key concepts, what to look out for, how possibly to mitigate these, and then thinking about how we at AJ Bell consider behavioural finance and put it into our investment process. And then lastly, finishing up on what our investment proposition is. So to start with behavioural finance, first I really want to talk about what behavioural finance isn't. So the efficient market hypothesis is more traditional investment theory, which really started or penned into paper in the 1960s by a gentleman of the name of Eugene Farmer. And what this investment theory stipulates is that markets are efficient, i.e. that actually it's not possible to generate consistent alpha because all information is already priced into the markets. Now, the interesting thing about behavioural finance that actually contradicts this thinking. Behavioural finance was really came to fruition much more recently in the last couple of decades, and it really argues and contradicts the efficient market hypothesis by stipulating that markets aren't efficient, but goes a little bit further to explain the reason behind why different markets aren't efficient, and very much puts it down to the rationale of human beings and the fact that share prices can become mispriced through either overvaluation or undervaluation through the course of time. So this is a picture of Benjamin Graham. He's very well known for his Intelligent Investor book, which was released in 1949, and there's been lots of different versions since. It's a very good read, but he's really regarded as the father of value investing, one of the first people that really took value investing seriously. And I think the thing that made him a very credible investor is he was very much ahead of his time. So if I think of one of his famous quotes, the investor's chief problem, even his worst enemy, is likely to be himself. This really is summing up behavioural finance, but actually way before behavioural finance was even coined as a term. Now, behavioural finance itself, as I said, is quite a relatively new concept. It's very much a branch of different types of economic sciences. It stems from psychology, neuroscience, macro and microeconomic theory, and it really came to fruition in the work from about, I'd say, three key people really. So Daniel Kahneman, Dr. Robert Shiller, and Richard Taylor, and they all won Nobel Prizes in the field of economic sciences for their work within the impact of behavioural finance. Now, if we really had to distill behavioural finance into kind of one key sentence, I really think it's really the last bullet point, which is quite powerful, is behavioural finance studies the psychology behind this financial decision making. Now, I want to talk a little bit about Daniel Kahneman first. Now, he's written a book called Thinking Fast and Slow, and it really is a very good read. I really would suggest anyone who wants to delve a bit more into psychology and the psychology of investing to really think about going out and purchasing this book. So he talks about the brain really having two systems, system 1 and system 2. And system 1 is very much the fast thinking. It's the autopilot. So it's if you're asked to do a very simple mathematical equation such as 2 + 2, you can actually answer 4 without going through a kind of mathematical process to get to the answer. Or when you open the door, you just open the door. You don't think through the processes that you have to go through to open that door. Whereas the slow thinking parts of the brain, system 2, goes through these processes. So if you calculate 17 times 14, you don't off the top of your head know the answer. You have to go through the multiplication process to get to that answer. And it's very interesting the way the brain works in terms of moving between system 1 and system 2. And I think the biggest flaw that Daniel Kahneman sees in system 2 is that you can't actually turn off system 1, and system 1 has to tell system 2 to start working, which is the concern in terms of how we invest, and the fact that if we're just working on autopilot, maybe we're not considering all the information. So on this slide here, we have the Muller-Lye illusion. And if you look at the two lines and you pose the question as to which is longer, you're most likely to say A, and that's the line I certainly would have gone with at first. And it really does distinctively look a lot longer than B. But actually, that's very much part of the brain that system 1 is just making that assumption for you. Now, actually, if you could tell system 1 to turn up and use system 2, what you'd actually do is maybe measure those lines Now, if you measure those lines, you'll actually realise those lines are exactly the same size, and it's actually an illusion. Now, interestingly, taking that step further, now that you know that, and obviously I'm explaining this to you now, it actually works an informed belief, because we still see, even though we know this, and even after maybe we've measured those lines, we still see line A as being longer. That really is the dangers of how system 1 and system 2 work in the brain. But maybe a bit more financial behavioural finance now. So I guess the real issue with behavioural finance and where you can really see it working from a day-to-day perspective is in financial bubbles and crashes. And we've had many of these through the centuries that you can point to in investing. But I think probably the two key ones I want to talk about today is tulip mania and Bitcoin. So I guess the one thing these two investments have in common is they're very speculative. So back in the day of when there was trade roaring through the Netherlands, the contract price for tulips got bid up so high to such extremes that it really did form quite a bubble. And the same happened with Bitcoin much more recently. But the reason I say they're speculative is because to value an investment, what you really need is some kind of cash profile, some type of dividend, some payback that you can then pencil into a ratio in terms of when you get your full payment for investing. Well, the problem with these two investments is you never get that. It's just purely speculative. So they got bid up to such extremes and then crash right back down. So I think that is a really good example of behavioural finance. Now, what I also think is very interesting in these two examples is that actually tulip mania issue was actually probably one of the first recorded financial bubbles, whereas Bitcoin was the last one. So I think really what it shows is that even after all this work in the field of behavioural finance, all the academic work that's been done, is that actually we as collective group still very susceptible to some of the issues that relate to behavioural finance, and the fact that only a couple of years ago Bitcoin got bid up to such big extremes. And I guess possibly it's technology which fueled Bitcoin, the fact that everyone could really see what was going on, and actually everyone became very greedy on that aspect. If there was an interesting fact on Bitcoin itself, that actually in 2017, when the price was doing so well, I looked into the online encyclopedia, Wikipedia, and actually Bitcoin was something like the 9th most hit article out of 50, with the hits ranking up to the peak at around the 7th of December. Now, that doesn't come as a surprise to me. That coincides with the peak price being on the 17th of December. Now, if we look into 2018, it doesn't even feature in the top 50 articles. So I think that really does give such a great example of investor behaviour, and the fact that now that the price has fallen so sharply, and the fact that just no one's actually interested in investigating that particular investment. And we can also see it in the media. Just think of the last time you actually saw it in the newspapers compared to a couple of years ago. It was much more in really every headline each day. So then how the financial bubbles and crashes form, well, I think they really generally seem to go through this investment cycle, a consistent investment cycle in every time. And it's when people get to this euphoric point that actually they seem to ignore the risk, and that is probably the most dangerous point. It's the maximum financial risk. And actually, on the flip side, the lowest amount of risk is probably at the point where people start to capitulate, panic, and have despondency on their stocks. And possibly they think that's the sign that maybe markets just aren't for them. And then what we can see is the cycle tends to happen again. So I think it's an important statement that actually to bear in mind that whilst history doesn't necessarily repeat, we certainly do think it can tend to rhyme. So actually now looking on the behavioural finance concepts themselves. So the real bad news, I think, here, unfortunately for us all, is that actually the way our brains are hardwired doesn't actually make us very good investors. So we do need to really think about processes to eradicate those emotions that are the things that make us bad investors, to turn us into much better investors. Now, the formal behavioural economics group seem to recognise about 100 different concepts of behavioural finance. Now, some of these clearly do overlap, and maybe some are a bit contradictory, and possibly some aren't really biases, but there is about 100 at the moment, so you can see the extreme number of different biases they consider. If we just maybe touch on a few briefly before I go into some a bit more detail. I think an interesting one is something like self-attribution. Now, this bias basically suggests that anytime we do something well, we congratulate ourselves and we think it's purely down to our own skill. But then if something actually goes against us, we don't necessarily criticize ourselves as such, but we then tend to look at where the bad luck might have fallen. So we then don't really whilst we take the credit, we don't then take the fact that maybe this was something to do with ourselves. And then I think anchoring is an important one as well. So anchoring really is where you just anchor something to an irrelevant level. So for example, if you went to buy a car in the car showroom, you saw the car you wanted to purchase at about £8,000, let's say, for example, and the next week you go back, you decided not to buy it, the next week it was £7,000, so you thought it was a really good purchase. You might feel compelled by the fact that it's on a bit of a discount and actually think, great, I can now buy that car. Now, if you thought of yourself in a parallel universe, and actually if you had gone to see exactly the same car and it was £6,000 and the next week it was £7,000, you're very unlikely to purchase that car, even though it's the same person looking at that car and it's the same car, but it's just because you anchored it to completely different levels. So I think this can be really dangerous in the investment world. If we touch on a few more concepts that I think are maybe a bit more relevant to investing per se, and we'll go through them in a bit more detail and actually look at how to mitigate them. So overconfidence bias, I think this is a really interesting one. So this really is a tendency to be overconfident in your ability or think you know more than you actually do, so overconfident in your knowledge. And I think there's a really good example in the study of where people were asked about their driving ability and whether they thought they're an above average driver. Now, the study I saw, and it was a fairly big sample size, so we believe it is fairly representative, it actually showed that about 93% of people seem to think they were better than above average driver. Now, clearly that's impossible and it should be 50-50, but what that tells us is about this 43% of this overconfidence bias coming in. Now, that can be really dangerous, particularly in the investment world as well. So the reason we think it can be quite dangerous is because it could lead to over trading. So you may become too confident in your ability to spot new ideas and then move on from them, buy other new ideas quite quickly. Now, of course, we know the costs that come with trading, which means it's an even harder game once you've got those costs to take into account for as well. And the other issue maybe with overconfidence is that actually you might end up taking on more risk than you realise. So you may not diversify enough. You may just think that the 5 ideas you found are the best ideas, you only want to put all your capital into those ideas and just not diversify enough. And then what the knock-on effect of that might be is that you haven't considered the inherent biases. So there may be a correlation to the oil price in all those 5 ideas, but because you were so overconfident in those 5 ideas, you didn't actually take the time to step back and consider the other risks. So I do think overconfidence can quite be quite a bad bias, and you do need to be aware of it. Now, how can we mitigate? I think very simply, and it's a little bit like value investing, I think considering a margin of safety in everything you do, just to counteract that bias, could definitely help. The next one I want to talk through, which is potentially even more dangerous, but we see it all the time, is the confirmation bias. So the confirmation bias really is the tendency only to seek out information that really confirms your thesis, and just ignoring every other piece of evidence, and maybe all the disconfirming evidence that's out there. So actually, if you look at the Venn diagram, it just really sums up exactly what we're doing. So, you know, it's really just the intersection of what you see and not the rest of the facts. So I think, you know, how do we mitigate against something like this? Well, I think you definitely need to play devil's advocate. So if you spent 3 days researching into your idea and you decide a conclusion, take a whole day, and it may feel like a wasted day, but I assure you it's not a wasted day. Take a day to play the other side of the coin, look out for information that really disconfirms all the evidence you've just confirmed, and actually take time to consider that and just think about where you could be wrong. Now, if you're maybe doing your investments with a friend or you're part of a bigger team in the institutional world, then really separate yourselves out to make sure you argue against each other. Now, you don't necessarily need to believe the argument you're putting forward, it just needs to be well-researched arguments that you've considered both sides of the story. The next one I'd like to talk through is loss aversion. Now, this really is the idea, the tendency that people prefer to avoid losses than actually acquiring equivalent gains. So for example, if I was to ask you to bet with me on tossing a coin, and if it was heads, I'd give you £5, and if it was tails, you'd give me £5. Well, actually, the theory behind that tends to show us that people don't really want to play that, and really we'd have to bring those gains up to about 2.5 times. So the utility function is about 2.5 times of that kind of pleasure of gain against loss. So really you need me to be offering you about £12.50 against the 5 to actually consider that to be a good investment. So it's this idea that you prefer not to lose £5 than actually to gain £5. It's the psychological pain that involves here. So for example, it's why actually art dealerships sometimes give out their paintings to people to put on their walls for a week, because they know that actually the psychological power of people having to take that painting off their wall and give it back to the dealership rather than just purchasing it after a week is so much more powerful, because it feels, even though you didn't own that painting from the beginning, it feels like a loss that you actually have to take it off the wall. And the problem here is that what it leads to is that people don't like to crystallize their losses, even if it considers to be the right choice. So what I would consider here in terms of changing your perspective and how to mitigate against this is just ask yourself, would you be buying that stock today? So forget the idea that maybe you own it and it's down 10, 20%, and you don't really want to crystallize that loss. But ask yourself, redo the research, would you be buying it today? And I put it to you there, actually, if the answer is no, you really might have a different reflection on the stock that you have. And of course, let's remember that actually the government themselves benefit the opposite, that actually they're very happy to give you a benefit from crystallizing losses that you can offset from future gains. So it really is something to be very aware of. And I guess the other point of view from as an advisor talking to a retail client is just to remind people that actually they should expect some at some points through investment cycles on different types of investments, losses. And in fact, if you didn't have the losses in the portfolios and everything was just always positive, then actually potentially you're not actually taking enough risk within your investments, and that you do need to think of everything as a long-term objective, a long-term journey, and that losses shouldn't necessarily be seen as a risk as long as they're managed in terms of long-term goals. And then herd bias. I think this is probably fairly well known, and certainly the diagram in the right top corner hopefully tells most of the story here, but it's the idea that we just follow people without really having done any research for ourselves, and just because everyone else is doing something, it must be good. So, you know, the dot-com boom is a great example of this. Questionable business models that weren't paying any earnings to anyone, just being bid up by investors to unsustainable levels. And this really does tie up with a kind of greater fool theory, where actually all you end up doing is just believing there'll be a greater fool out there that's willing to buy at a higher price. But the question is, of course, what if that greater fool never exists? So I think to mitigate against this bias, it's just saying make sure you do your own homework, make sure you're willing to understand why you buy something, for what reasons, and it's not just because someone else, a friend, told you it's a great idea, or someone else is buying or seeing large swathes of investors following that trend. So in terms of a real life example of herding, and I think this is a really important point, I saw this in a presentation recently, I really wanted to include it here because it really does bring it to light, is that this is Nintendo's had its struggles over the past, some questions of its product cycles, etc. But what you can see here is the thick blue line is the share price. Now the green and red bars are the analysts that are in the market. So these are institutional analysts recommending this stock to other institutional, albeit fund managers or pension schemes. And what we can see here is that the amount of analysts, and these are the same analysts, it's the same group of people, the amount of positive analysts that are buy rating that stock really does seem to correlate with how the share price is acting. So for example, when the share price has been doing very well, is at its peak, we seem to see lots of buy analysts, people confident that it's the right time to be buying that stock. And obviously the converse is true for the sell analysts, so not many sell analysts. What we can see, as soon as there's doubt in the market and the share price starts to fall and fall and fall, people seem to capitulate, and they all seem to capitulate together. And actually at the lowest point of the share price, and we can tie this back into the investment cycle, the point of actually most likely minimum risk is when everyone seems to capitulate, and you can see in the middle of the chart where that then becomes the time where it's the most sell analysts and all the buy analysts have now defected and deflected over to the sell analyst side, and you can see it nearly ties into the bottom of the share price, and then time happens again we can see from kind of March 15th the share price starts to rally, and then people start to get a bit more confident in the stock. So we really can see it's very prevalent also in the institutional world as well. So I guess that's kind of running through some of the key concepts. I hope it's given you a good flavour there. But just thinking about a few quotes from some very well recognised investors, I just want to read them through because I think these also sum up behavioural finance really nicely. So if we think of one of Warren Buffett's most famous quotes is, "I'll tell you how to become rich. Close the door, be fearful when others are greedy, and be greedy when others are fearful." He's really talking about being a contrarian investor and just not following the herd there. And then Sir John Templeton, the four most expensive words in the English language are "this time is different." And then again, Philip Fisher, "The stock market is filled with individuals who know the price of everything but the value of nothing." These quotes really are summing up behavioural finance at the heart. And I think they're definitely worth taking consideration. Now, to conclude behavioural finance itself, I think the question probably is, with all the academic study and literature that's gone on, the fact that we now know behavioural finance much better, is there a cure? Well, I don't think there is, and I think we saw that with the example of tulips and then Bitcoin, and Bitcoin being much more recent, the fact that we are still very susceptible as a group to these biases, and they're built into, hardwired into our brains. They're very difficult to overcome. I think we can possibly overcome some of the effects of cognitive behaviour, avoid some of the major possible pitfalls, but we need to keep reminding ourselves time and time again. Now, there is a lot more work being done on de-biasing and biasing modification, but I think it's going to be incredibly difficult for everyone as a group to overcome these behavioural finance concepts. And I think the issue also arises that we're actually, they evolve, and they were actually investigating and finding new ones every year, really. So I don't think there'll ultimately be a cure, but I think we definitely can learn from history. And I think in turn we'll be able to improve our investment decision making. But as I said, I don't believe we'll get to a point where the efficient market hypothesis necessarily stands true. I guess maybe the last point here is that it's becoming more and more important for advisors to become more like behavioural coaches as well, and just help people to remind them through their investment journey. So I think if we think of the last quarter of 2018, how relevant that was, just think about maybe the amount of clients that came to you and started to panic when markets were potentially 5 to 10% down. But I think, as ever, you take a step back with your clients, remind them of the investment journey, and also remind them to what they've signed up to. So go through the RTQ with them, the fact that possibly they stipulated they could weather returns that fall much further than 10%, and just remind them of that, and that it is part of their investment journey. So now really I want to come on to how AJ Bell ourselves think of behavioural finance and how we try and eradicate behavioural finance concepts that we also are susceptible for. So we build our philosophy on four key cornerstones, and I think for today's conversation it's really the middle two that are the most important. So in terms of behavioural finance, we remind ourselves that we're long term, we're not trying to guess what the markets are doing from day to day. JPM showed this in a very good study in one or two charts, is the effect that the best 10-day returns have on the last 5 years, and it is incredibly powerful. That actually, if you strip out those 10 days return, the performance return the last 5 years can nearly half. So the idea that any investor can determine what happens in the markets in any one given day is obviously just not possible. So we remind ourselves constantly we're long-term investors. We have tracking budget to adhere to make sure we're taking on enough risk. So we think it's incredibly important to be long-term investors. And the next one is just to be valuation driven, so that what we're ensuring is that through our valuation metrics and our capital market assumptions, is that we're looking to avoid some of the asset classes, or at least take some capital out and award capital for better valuation perspectives. So just not continuing to invest in over valued assets continually. The next chart really shows the behavioural mistakes of fund selectors, and it's incredible to see the average fund investor making the same mistake time and time again, and that really is the firing and hiring of their fund managers, their third-party fund managers they're using at the wrong times. Now, as I said, we try to be long-term investors, so ideally, like Warren Buffett, who likes to hold stock forever, we would love to hold a fund forever. But of course, the problem is fund managers do move, they retire, or they decide to take on a new opportunity at a different investment house, so it's not possible to do that, to hold on to funds forever. But what we definitely try and do is not sell people after a bad patch of performance if it can be explained. So the majority of the way people look at performance is actually through fund returns, but there are two different types of fund returns, and that's time weighted and money weighted. And actually, if we look at the money weighted return, what that takes account for is how fund flows are thrown into and out of the fund. And normally we find that those returns should fall short of the advertised return. So actually it's showing that investors do end up buying and selling funds at the wrong time. So in everything we do when we look at funds and fund managers, we're really trying to iron out our expectations of performance, so that we make sure, just because it might have been a growth market and we're employing a value manager, that actually we don't sell them because we wouldn't have expected them necessarily to have done well in that market. So we're always asking questions of funds that are performing badly, but also ones that are performing well. Just really, are they performing at the correct time in the market that we would expect them to be? The next slide, really, I've laid out how we undertake our research, and we broadly follow a 5P process. Now, this isn't necessarily that different to how other people are doing it, but I think it's the outcome that we're really trying to be very clear through when we follow this process. So we really want to understand those fund managers, which in my eyes leads to two outcomes. It really is characterising a fund, so understanding how a fund should act through boxing it into, is it a value fund, is it a growth fund, etc. What is the market cap, the average market cap of the fund? How does it behave? Does it trade a lot? Does it not trade a lot? Really understanding those behavioural aspects, and then also just coming up with a conclusion, whether we're positive or negative. Now, on the left-hand side is a template of our meeting note. Now, our meeting note goes through the 5P process, but I think more importantly, if you look at the fund opinion part of this meeting note, is actually what we're doing is really trying to distill into a few words how we think it behaves, should we own it, and what role does that fund play in the wider portfolio. Now, the last part of that section is really to understand what would cause us to sell the fund. Now, we do that, we lay out this set of scenarios that could cause us to sell the fund, preempting our own decision before anything happens, so that we're then not susceptible to biases of allowing us to maybe continue with a position when we shouldn't have. It's very easy for someone to try and convince us that actually it wasn't, maybe the star manager, the deputy manager was very influential and we can continue to run that process. But what we try and do is iron out in our head before anything happens what we think are the most important aspects of that fund. So, albeit, is that the star manager there, or is it a big bank of analysts? Which analyst is the most important? So that if something happens, we already know ahead of time how we should behave in that. So I think that's a very important part, how we really try and bring behavioural finance into our own decision making when we look at third-party funds. The next slide really just shows something from our own marketing material. So within our own range, what we try and provide people is an idea of how funds, the managed portfolio service, could behave in good markets and bad markets. So we show 10 years and 100 statistically, so it's not an absolute certain, but it's a good guide of how something should behave. So if you are in MPS 6, our growth managed portfolio, then actually you can expect that 10 in 100 years to lose nearly around 15% in any one given year. So we're really trying to help you manage your own expectations as well. Now, the last slide, I'm just coming to the conclusion here, is just laying out what investment propositions we actually have at AJ Bell here. And we really do try and offer numerous solutions so that our clients can choose what suits them best. So we do offer a range of a DT range of 3 to 8, so 6 portfolios from a passive implementation point, an active implementation point, and also have our passive fund of funds as well. Now, there's a lot of numbers here. It's quite a busy slide, but it's the bold numbers that you should probably pay the most attention to. And that's the overall cost when taking into account underlying charges from our fund managers, our own charge, and our platform charge as well. So I hope you'll agree they are competitively priced, but please do get in touch if you'd like any more information on the products themselves, or indeed how we break down the underlying costs. But otherwise, I'd like you to kind of view that in your own leisure, and please do come back to us if you have any other questions. Now, that really concludes the presentation. There's a couple of risk warnings there, but I hope you've enjoyed learning about behavioural finance. And if you have any other questions, please do get in touch. Thank you very much.